Good afternoon. Just checking with everyone to see if you can see the screen that's being displayed. If anyone can't, please send us a message. Hello and welcome to this Enterprise Live online event. We're glad to have you with us. My name is Sharon McWilliams and I'll be your host today. Just a few logistics before we get started. Most of you are using the streaming audio, and it usually works just fine, but sometimes local conditions can cause interference. If that happens to you, you can switch to a phone line for audio. To get the dial-in numbers, click on the Request Audio button at the bottom of the participants list. If you would like a full screen view of the presentation, click on the full screen icon on the upper right side of the presentation area. Hitting the Escape button key will bring you back to the regular view. We're looking forward to your questions, and you can submit them anytime by using the Q&A panel located at the bottom right-hand side of the screen. As it says here, please direct your questions to all panelists, which is the default. We will address questions at the end of the session during the Q&A period, so please be patient with us. As with all of our live online events, this session is being recorded. We'll be sending a link to the archive to all of today's participants within 48 hours. When you leave this event, you'll automatically be taken to a brief evaluation survey. We'd love to get your feedback. It helps us keep Enterprise Live online events relevant and useful to you. So we're going to go ahead and get started now, and I'm going to pass this over to Laura Turner, who is our Enterprise's Senior Disposition Manager. Laura?
Thank you, and welcome, everybody. We are here in Columbia, Maryland today. And again, if you're having any trouble hearing me or seeing the presentation, perhaps you could send a chat. We've got staff in the room monitoring questions and chats. Here in the room with me today is, again, myself, Laura Turner. I'm a Senior Disposition Manager with Enterprise's Year 15 Department. Also Sean Barnes, also a Senior Disposition Manager in our Year 15 Department. We have a small department here at Enterprise that exclusively works on investor exits from our LIHTC deals on a daily basis. That's what we do day in, day out. And we also have Candy Felix, Director from our Tax and Regional Accounting Department here, who can assist with all of our capital account questions, exit tax discussions, and so forth as far as it's related to Year 15 dispositions. So for some national orientation, within the LIHTC program, there are nearly 3 million units of affordable housing nationwide in urban, suburban, rural markets across the country, housing low-income families, seniors, persons with special needs and disabilities. And according to a recent HUD report, 64% of those residents within the national LIHTC program are at or below 40% of AMI, which is evidence to the deep and low-income targeting and population that this program is serving. The extended use requirements of these projects is increasing, at least in our portfolio. We're seeing a rising wave of deals reaching the end of their 15-year initial compliance period. Here at Enterprise in particular, we're going to see a bump around the year 2022 and 2023 in terms of deals that are eligible for the investors to exit at about 140 deals per year. So we hold these webinars on an annual basis for individuals that might just be interested in this topic from a policy perspective, and also for our operating general partners who may be working now or in the upcoming years working on one of their first Year 15 investor exits for deals in their portfolio. So we'll keep the discussion high level and broad, not necessarily assuming the audience has a great deal of experience with year 15, but also we're going to be talking about recommendations that we have for our operating general partners on how they can prepare for year 15 for their particular deals. So again, our experience to date here at Enterprise, we have transferred or approved of a transfer plan for over 900 projects, and our current pipeline is in excess of 100 deals per year over the next 5 years that we're working on and trying to transact an investor exit for each and every one of these. And our objectives for today's discussion, first and foremost, to provide a general background on year 15. We're going to discuss some key exit options, including a right of first refusal and a buyout option, which we typically see in Enterprise's standard limited partnership agreements. We want to highlight different perspectives of the different stakeholders in this process. We have some information on resyndication potential, how capital accounts play into this issue, again, recommendations for our operating general partners on how they can plan for year 15, and some of the good detail is going to come towards the end when we review some case studies and how some of these might actually play out. Here in Enterprise Year 15 Disposition Team, we have this 4-step mantra that we repeat over and over again. Really can't highlight the importance of these basic concepts enough. First and foremost, to know the property in terms of recommendations to an operating general partner, knowing what the property needs, not just in terms, this goes beyond just the investor exit, but really speaks to our desire to preserve the affordability of this housing stock and what these properties might need long after the investor exits in order to maintain physical and financial viability. Step 2, know your partners and your stakeholders in this process, particularly the investor exit process, but then beyond that into any refinance or resyndication that you may be considering for your property. Know your documents. Again, the buyout option and the right of first refusal are 2 very key elements in your documents that we're going to review today in terms of what they typically say. And last but not least, we really want to encourage our operating general partners to develop a plan, not just for the investor exit, but for long-term preservation of that property. The stakeholders in this process include the residents. Residents typically will not be impacted by the specific act of the investor exit, but we find that there are many deals out there that maybe undergo a substantial rehab after we exit, and or we have operating general partners that seek lease purchase programs. So that's the extent to which your residents may be impacted and or engaged in thinking about what you want for them in this process. Obviously, there are general partners, sponsors, the original developers, of which there may be multiple entities and or joint ventures. There are the investors, be it one or many syndicators representing those investors. Private and public lenders may have different concerns at year 15 with the investor exit and what they want to see for the future. The terms of their loans probably greatly exceed the initial 15-year compliance period in which the investor is involved. They have a longer hold, so to speak. The allocating agencies and, of course, the IRS, who still has the ability to audit the partnership tax returns for 3 years beyond the year 15 tax return date. To back up and provide some basic orientation to how these investments were structured on the front end to provide a basis for the rest of this discussion. Enterprise is a syndicator. That means that we connect the investors above us who want to invest in these deals with these little lower tier houses that you see at the bottom of the screen. We're connecting the capital from the investors up top to investing in the deals down below. In that middle box, which is the equity fund, we're going to collect money from the investors. We are going to represent that 0.01% general partner in this deal, and as our role as a general partner, we have day-to-day management authority over the fund for certain actions, which operating general partners may be very well aware of, such as refinancing or certain exit strategies. Even though we have the authority to manage the fund, there are certain actions, such as those, that we may need to go up to that investor or multiple investors to get their consent to certain actions. And then that money is invested down below in usually multiple different housing projects. And, Sean and I on a daily basis may be working to exit any one of these 5 little houses you see below. So we're negotiating one-on-one with the GPs at the bottom of your screen, representing the 0.01% general partner of what we call the lower tier, and that equity fund we often refer to as the upper tier. We're negotiating exits down below with each one of the representatives of each of those housing projects, and that is, this is just a reminder that sometimes we're negotiating there, but then also may need consent from up above, structurally speaking. Again, as some more basic orientation, a reminder that these investments are typically sold through limited partnerships or limited liability companies. And again, at the lower tier, partnership agreements control provisions for dispositions, including but not limited to transfer restrictions and price, the consent requirements, distribution of any proceeds, and how liquidation and or dissolution would have to be executed if that's being contemplated. So this just gets into that part of that mantra about knowing our documents. This is one of the first places Sean and I go to when we're starting to look at a new deal that's eligible for disposition. We review that lower tier partnership agreement for these types of provisions and requirements. Who has to consent to what? Who has what rights that they can trigger automatically? And again, if there are sales or proceeds, how do those flow through the various waterfalls? The types of investors in these LIHTC deals nationally vary. We see a lot of banks particularly making direct investments into the LIHTC deals, and again, Enterprise is a syndicator, perhaps an intermediary, where we may represent various funds, which could contain anywhere from a single corporate investor, which we might call a proprietary fund, or multiple investors. We don't see too many funds where there are multiple individuals as the investors in that fund, although they do exist. And then your types of syndicators nationally are going to vary. Enterprise is we have a national nonprofit as our parent corporation. We are mission-minded. You are also going to see international for-profit syndicators who work nationally, and regional syndicators who are mostly nonprofit that may only be investing in specific states or regions. And then in terms of Enterprise as a syndicator, our goals when we're negotiating these individual investor exits at the lower tier are first and foremost to deliver the expected benefits to the investors. We do have a fiduciary obligation to them. Administratively, we do want to arrange for their exit as early in year 16 as possible in order to avoid ongoing management, ongoing review beyond a time frame that's really necessary. We do always seek to transfer to the original sponsor or developer. Our documents tend to be set up with that in mind, with the deal going back to them. We provide resources to our sponsors where we can to help them develop their year 15 transition plan and discuss their long-term plans and the needs of the property thereafter. We want to preserve affordability. We want to minimize displacement of our low-income residents and preserve the overall project viability going forward, because we believe that really that's in alignment with the original intent of the LIHTC program, and we want to continue to see that program succeed going forward. We can provide resources to our lower tier operating general partners where needed if they want to re-syndicate the deal again and or refinance, since Enterprise does have debt products available. So I can get into some specific exit examples here if we're just specifically talking about options for having an investor exit a lower tier. I'm going to talk about the right of first refusal, which is a right for a qualified entity to purchase the property. I'm going to talk about a buyout option, which is an option to purchase just the investor's ownership interest in that entity that owns the property. Bargain sales, early exits, puts, which are typically options for the limited partner to put their interest to a specific party for a particular price, a defined price, typically the original sponsor, general partner. And then briefly, sales to third parties as an option for the investor exit. First and foremost, again, is the right of first refusal, which is specifically allowed by Section 42 of the Internal Revenue Code, which gives a qualified entity a formula price to buy the real estate for debt plus exit taxes. In truth, we don't see many general partners exercising this option at the end of year 15. It is becoming more common, but the reasons, some of the typical reasons general partners are not pulling the trigger on this option themselves is first and foremost, there are questions, often questions about whether or not it is necessary to go out on the open market and find a bona fide third-party offer to purchase that property in order for the general partner to be able to pull the trigger on their right of first refusal. The right of first refusal, secondly, is typically only a right to purchase the real estate for that formula price of debt plus exit taxes. And there may be certain circumstances where if you did transact that sale of the real estate, dissolved the partnership, that the residual reserves and or cash accounts could get distributed to the various partners within the partnership. There are transaction costs also associated with the sale of real estate, such as transfer taxes and or recordation fees, perhaps also some costs with dealing with a lender of paying off a loan and or assigning that to the new owner of the property. But most of all, what we're really seeing is that the formula price of debt plus exit taxes may often exceed the fair market value of that property on the market. Second option, which is typically in enterprises, lower tier partnership agreements, gives the general partner or a sponsor the right to purchase our investor interest in that limited partnership or LLC that owns the real estate for a price that is equal to the greater of the fair market value of that ownership interest or any unpaid benefits plus the exit taxes that would be triggered by the investor exit. And then key here also is that fair market value of that partnership interest is going to be defined in the partnership agreement, and typically it's defined as the price a limited partner would receive if you sold the property for an appraised value and then took the residual proceeds through the various partnership dissolution waterfalls. So even though it is an option to purchase the ownership interest, it is for a price that is modeled off of the sale of the real estate. We continue here at Enterprise to see a pretty hefty interest market-wide on early exits. After 2008 and legislation that was passed in that year made it a little bit easier for parties to execute early exits where they so desired to do so. And that is where an investor can now dispose of its interest prior to the end of that initial 15-year compliance period, provided that the compliance is maintained and expected to be maintained through the end of year 15. However, we are seeing that early exits just simply may not be feasible for multiple investor funds. And for all early exits, what you're probably going to see, regardless of who your investor or syndicator is that an indemnity is going to be required to protect the exiting investor through the end of year 15. That indemnity is typically expected to be stronger than any credit guarantees that exist within the limited partnership agreement, because that investor may need to be incentivized to exit early as opposed to staying in through the end of year 15 and being able to continue to monitor the property for compliance and protect their right to those credits that they took.
All right, I'll pick up here and talk about the limited partners capital account. But before we, about exit taxes, but before we talk about that, I wanted to just talk about some components of the limited partners capital account. And the balance of the capital account really consists of the capital contribution, the initial investment that the limited partner makes to the partnership. It's adjusted for any distributions that might be paid out, and tax losses or taxable income. Most of our partnerships are not underwritten to generate income, but we do have some of those, and if we did have income, it will be added to the capital account. There's an adjustment for historic tax credits. If the partnership is getting historic tax credits, that's an immediate write-off to the investment. We do have some discussions that are happening now based on the recent tax laws, if those adjustments are going to be in the first year or over a 5-year period. So that's, we're still waiting for a direction from the IRS, some clarity on that. But it will affect the historic credits do affect capital accounts. It will also be adjusted by any syndication costs that are paid by the limited partner. By definition, the limited partner's capital account cannot go negative unless there's minimum gain. Now, minimum gain is a tax concept. It's probably something that we can talk about for a whole day, so I'm not going to get too much involved in what's included in that, except to say that there's two major pieces: the non-recourse debt that is secured by the building, and the net book assets, which is the historic cost net of depreciation, taxable depreciation. We're looking for tax basis, so if there's any gap tax adjustments like depreciation, we'll make sure that we're using the taxable depreciation to calculate. We track, or if you've got a partnership or enterprise, we track it on the tax basis, so we know what that is, and if you need help with determining at any time what your tax capital account basis is, we could share that with you. Not a lot of CPAs keep it on the tax basis, so we want to make sure that you are using the tax basis when you're looking to make sure that the capital account is, for tax purposes, is correct. The limited capital account, the limited partner's capital account must be zero upon transfer of interest. If the ending balance is positive, a loss or reduction must be reported to write off that investment. It means that we invested more than the benefits that we got, and some of our deals are structured that way. So the original investment plus any income and net of any losses or distribution would be positive, and then we have to write that down. If the ending balance is negative, then a gain is recorded, which means that the benefits that we took exceeded our investment. And that's where the concept of exit taxes come in. You've taken more benefits than you've invested. By definition, the limited partner is limited to their investment, so they're not allowed to go over. So if they do go over, then you've gotten more benefits, and that triggers exit taxes. More and more investors are understanding this. The concept of time value of money, $1 today is worth more today than it is in the future, so we consider that too in our analysis. So I just want to quickly go through an exit tax example for you. In this case, we've got like Laura mentioned, the taxes determined by the sales price sales price is usually debt plus the exit taxes. And in this example, our limited partner has a capital account balance that's negative $500,000. And our discussion is that if we've got a capital account of negative $500, means that the limited partner is taking extra benefits of $500,000. He can only do that if there's minimum gain. We require that the partnership agreement require that the general partner pays the exit taxes. So, for instance, if this is 35% federal tax rate, which has been changed in the last, so we need to update our schedule. It's 21% for the most part. So the federal rate in this example, just to continue with this, if our federal tax rate was 35%, then the exit taxes on a limited partner's capital account that had a negative $500,000 would be $175,000. Because that $175,000 is expected to be paid for by the general partner, it creates a taxable income event for the limited partner. So then there's a one-time growth of factor of another 35%, which will take us to a total of $236,250. So if you just think about it, if you've got a negative $500,000, creating exit taxes, we're asking for $250,000 of creating an income event of $236,000 that we have to pay. Enterprise just does it one time. Presumably, you could say every time you get an income event, there's a taxable liability, but most of the industry understands that it's just a one-time growth of factor. And I know we'll talk about probably later in the presentation about the exit taxes and if we impose those.
And we're just going to scroll, take a look at some questions first before we move on, just to make sure we're addressing everything. I see a question about whether or not CDFIs are also syndicators. I don't precisely know the answer to that. I know they very well may be affiliated with CDFIs, but I don't think I know the specific answer to that. There were some questions about whether or not the slides will be available after the webinar. Sharon, do you know if they will be?
Yes, they will be emailed to you within 48 hours.
And then saw that email from Dan. Yes, the tax rate has changed to 21%. So we need to update our.
There's another question about, does the money for taxes come from the reserves? And I assume that is related to exit taxes.
Yes.
And the lawyerly answer to that question is that it just depends. I think Sean's going to get into some examples later where we are going to talk about, maybe part of the GP's plan, operating general partner's plan, when they're approaching year 15, is to consider the best source for payment for those. And then there seem to be maybe some deal-specific questions, so unless we're seeing anything else, maybe we'll continue on with the general presentation. Okay. We wanted to get into our general guidelines or recommendations for our operating general partners on how they can start planning for an investor exit, starting as early as year 10 for a particular deal, which is really when we recommend GPs start looking at this in earnest, although you could also say that planning for year 15 is a 15-year endeavor. But starting in year 10, after your credits have been delivered, let's just say, generically, let's not only develop a strategic plan for getting your investor out at year 15, but how are you going to preserve the property thereafter? Because what you probably have is a property that has not had a significant renovation for the last 15 years, and a lot of capital needs can really accrue in that timeline, and you can have a lot of property systems that are reaching the end of their useful life at that time. So with some basics, let's start by determining when the compliance period ends. That is based on a building-by-building basis on when each building started taking credit. So you may have a different, each of your buildings within a particular property may be reaching year 15 at a different year, and Enterprise does not typically exit that partnership until all the buildings are past year 15. General partners may want to ask themselves if they have the desire and the capacity to purchase the project and or in general just continue on with ownership and operations. In our experience, our general partners almost always have wanted to continue to own and operate that property, but there are certainly exceptions where an organization's mission could have changed over the last 15 years and maybe housing just isn't a part of their mandate any longer. And from the investor perspective, considering whether or not the investor is flexible with the sale or transfer and whether or not those investor benefits were realized, these are just things to start thinking about. They're not necessarily action points within year 10 or 13, but information you want to be gathering and thinking about for planning purposes. There we go. And continuing on in year 10 and 13, we recommend reviewing the current performance and development projections in terms of how are your operations going to be sustained going forward. Is there cash flow sufficient to fund your reserves to a level that's necessary? Are there any anticipated major changes in your budget coming up, such as a loss of rental subsidy or tax abatements? And is your project still marketable in its current form and condition? Is there any change that might be needed in order to maintain that market competitiveness for the long term? We strongly recommend that our operating general partners stay up to date on long-term capital needs assessments. Some groups are perfectly capable of completing those assessments in-house. We do also support going out to third parties to get a formal capital needs assessment. We also highly recommend that groups consider getting a green capital needs assessment that can help you make decisions in terms of where you're spending the most money on utilities and where some additional upfront capital investment in efficient systems could help you with that. That's just, you know, we support that because that's good asset management of your product. Again, considering what are your reserve balances, who are they restricted by, and under what circumstances will they allow reserve withdrawals to assist you with some of these endeavors and long-term improvements. And again, being aware of your capital accounts and exit taxes and how will exit taxes be handled at year 15. Here's a little spoiler in that what enterprise sees more often than not is that a majority of our deals do not have value in excess of debt. And in those circumstances, what we are seeing is that the investors incur their own exit taxes on their own tax returns. That is one option. There are also certainly other circumstances where those exit taxes will need to be paid by the general partner or partnership. So we'll go into some more detail on that later. And as you're getting closer to year 15, maybe in years 13 and 14, we recommend a review of partnership debt. How does the public purpose debt impact your disposition in terms of, you know, do they have restrictions on the reserves and how those can be used when an investor exits? Are they going to need to approve of an investor exit? And then, you know, beyond the investor exit, are there going to be balloon payments? How are you going to address that debt when it comes due? Can your loans be assumed, forgiven, or restructured, particularly if you're considering restructuring the ownership of that LIHTC deal? We recommend determining the likely purchase price, looking at that buyout option or that right of first refusal in your lower tier agreement or any other agreement that does exist, because they're not all exactly the same. Doing a calculation of what the limited partner would get under each of those scenarios and determining whether or not that price makes sense to you in terms of what you feel the true economics of the deal are. We also recommend exploring sources of capital to meet that purchase price and any capital needs that the property has, be it refinancing using reserve, weatherization, funding, and or grants, or a combination of these sources. And then as you're ready to negotiate the actual investor exit closer to year 14 or 15, we recommend that every operating general partner consult with both an accountant and an attorney, meet with their syndicator, negotiate that purchase price. We typically, where our limited partnership agreements have buyout options or right of first refusals, we'd ask first, these are your rights to pull the trigger on. Do you intend to do so? And then if the general partner does not desire to do so, what we're typically left with is a negotiation. Then we do, this slide says sign a letter of intent, but what we've been doing lately is sending out something a little bit more informal. It is a letter of intent thing. Here maybe we've come to a soft agreement with our general partner on how we want to proceed. We'll get that plan approved of internally, and then we'll send a letter of intent summarizing the conditions under which that has been approved, but we're not typically asking groups to sign that and return it. The general partner should obtain any necessary lender approvals and or consents from the allocating agency that might be required for the disposition plan. They'll also need to determine what entity they want to acquire the limited partner interest. If they're, if we're just swapping out the limited partner, whether or not there's already an entity in place or whether or not they'll need to create a new entity to take over that LP interest. And then, draft some legal agreements. Enterprise has some very basic templates that we often start off with to reflect a transfer of limited partnership interest that we can work off of as a baseline. We don't ask our GPs to draft something anew because we do about 100 of these a year. We've got some pretty good templates that the investors have been exposed to and are comfortable with. And then in year 16, we often, if we can, we'll even come to an agreement with the general partner on an exit plan. We might even sign those transfer documents into escrow in year 15 to come out of escrow and be effective in year 16. Otherwise, as I said before, we're looking to close on that transaction, whatever it may be, in the first quarter of year 16 for the deal. The general partner may also need to file an amended certificate of limited partnership if the limited partner is listed on the certificate. You need to amend that to show the change in limited partner, but sometimes it only lists the general partner, and if that general partner is remaining, then there's no need to amend it. General partner will need to file a final tax return, including a final K-1 to the limited partner. And based on the tax bill that was passed in late 2017, we no longer need technical termination tax returns like we used to. It was essentially a partial year tax return. We no longer need that. We will just get a copy of the final year-end tax return. And then again, typically what we see with our enterprise deals is that we're actually effectuating the exit or the transfer via two documents. One is an assignment of limited partnership interest, and the second is a partnership amendment reflecting that change in partners. Let me I'll go through this slide, and then maybe it seems like we might have some more questions to address. And then if you're an operating general partner that has gone through a year 15 exit with an investor and or syndicator, we certainly hope everybody takes the lessons learned through that process and brings it back to the beginning if you're closing new deals. We're certainly supportive of this being a learning process so that we can improve the agreements and improve expectations for new deals. And I'm certainly not an expert on some of this, but considering your financing term and how those restriction periods played a role, how long your rental subsidy contracts played a role in your disposition's ability to pay your ballooning debt, the extent and durability of the improvements. It's because we are seeing those projects that only received a moderate rehab upon syndication. By the time they get to year 15, we are seeing a great deal more deferred exit on those and a much greater need for some sort of refinancing or re-syndication is needed to address failing systems with those than we are with the new construction of the substantial rehab projects. And the next one is clarifying the transfer provisions in the pertinent documents. Were those exit provisions clear? Did everybody understand them on the same terms? And, you know, is there room for improvement or clarity at your next deal? Reviewing the impact of state agencies' scoring criteria, and again, how were the projections? Was the property able to operate in a manner that was at all consistent with what the original projections originally contemplated? Probably not. There could be some lessons learned from that process. And then again, sometimes, you know, you're not going to have, I acknowledge you might not have a lot of options there either. And then considering the exit taxes and monitoring your capital account balances, how did that process go? Are there different assumptions that could or should be made going forward on your new deals? So, let's look at some questions. If there's a balance in reserve accounts, can those funds be used to offset exit taxes? Yes, possibly. Some of your lenders may also have consent authority on how reserve accounts being used, and if that's the case, they would certainly have to approve that withdrawal. But generically, the answer is yes, that could possibly be a source.
Yeah, we'd want to refer you to your partnership agreement and your loan documents. And actually, case study number 2 here, I'm going to address that a little bit in regards to how reserves can be used at year 15.
Another question, back to the basics, what date do we calculate from for the 15-year exit? Is it the 15th year after the 8609 was issued? And that is a great question.
No. It really depends on when the building starts to deliver credit. So if you've got a building that has a placed in service date of, for instance, 2016, but you are deferring credit to 2017, then that's the year when you start your year 15. That's year 1. So if credits are going to start in 2017, the easiest way to do that is just to add 14 years to that, and so 16 plus 14, 20, I'm an accountant and I can't figure that out. I don't have my calculator. But you can use your fingers and get to whatever that date is. So when the building starts to deliver credits, not when the 8609s are issued. So if you've got multiple buildings that are starting over a couple of years, then you have to go to when that last building first deliver credits and add 14 years to that.
Yep. Next question. If the project has Section 8 rents above the LIHTC rents, does the appraised value typically use the LIHTC rents or the Section 8 rents? And that is a perfect question for Sean.
So it's really going to come down to what the appraiser sees as the rent that's applicable to the stabilized net operating income or NOI. I'm going to lean towards the appraiser is probably going to use the Section 8 rents if that's historically what's been happening at the property. So in theory, you know, if you're trying to come up with a market value of the property, if somebody were to come in and buy this property, some market participant were to buy the property, would they be able to rent the property out at those Section 8 rents, or would it be the LIHTC rents? That number, those two, to answer those questions will get you at a stabilized rent, and then you'll subtract from that stabilized expenses to get to a stabilized NOI. So it really does come down to what the appraiser sees as what really is going to happen in the market for that property.
If no technical termination tax return is due, how do you address the percentage ownership for the K1 if you have two different limited partners, I've assumed this is totaling 99.99% owned by the investor and then transferred to the new owner?
So we will track when the actual termination occurs, and we'll estimate that if, let's say the termination occurs 3 months into that year, so in March the termination occurred, based on the history, we can tell what the expenses are and the revenues are, so we approximate what that number is in terms of the losses that should show up on the partner's K1. Now, the exiting LP would have its dates written at the top of the K1 so we can see. Coupled with that, your CPA should be checking technical termination on the return so that the IRS knows that this will have two partners in it. And we'll start with the partner that is exited will have a beginning ownership percentage, but he'll be 0 at the end of the year. And the new partner would have 0 at the beginning of the year, but 99 at the end of the year. So for us, we were just concerned about the losses that show up on those K1s. We want to make sure that the dates that partner is out of the partnership shows up at the top of those K1s, and it should be final for that exited partner.
You're going to have two K1s, a K1 for the exiting investor and a K1 for the incoming investor, and then the losses are going to be allocated appropriately depending on the actual day within the year that the transfer took place.
Yes.
Gotcha. Once the sponsor acquires the full ownership after year 15, are there any restrictions upon the sale of properties to an unrelated third party? There will be, once the sponsor acquires full ownership, there are going to be no restrictions on behalf, no consents you need to acquire from the investor. That being said, you could have other restrictions via your loan documents, agreements with other government agencies, such as your allocating agency via your extended use agreement or other regulatory agreements, but not from your investor. Once your investor is out, they no longer have any ownership percentage in that deal or consenting rights. That typically, that could be slightly different from early exits, since investors do need to, they're going to want to be assured of compliance through the end of year 15, because even if your investor exits early, they are still at risk of recapture if there's any recapture event. Do you base placement service date on the certificate of occupancy or percentage of lease up or other?
So placement service date is based on completion. So for new construction deals, we can use a temporary certificate of occupancy because we want something that says this building is in compliance for its intended use. So if you've got a temporary certificate of occupancy on a new construction deal, we can use that placement service. On the rehab deals, it's a little bit different. If you've met the minimum expenditure test, which is not a big tax concept, but that means if you spend, I think it's about $6,700 in this year, and that goes up every year by the Consumer Price Index, CPI. So if you've got a rehab project, as long as you've spent $6,700 or thereabouts on each unit, you can place that building in service. You can put a place in service date for that. So it's not dependent on the lease-up at all.
If a project was closed in 3 phases and place in service date occurred over a 3-year period, should we assume that year 15 will occur 15 years after the closing of phase 3? 15 years. I mean, generically speaking, yes, I would look at that, and I'm assuming by 3 phases we're talking about 3 buildings within one LIHTC project. Yes, it's that third building. If that is the last deal to have taken credit, yes, I'd find the first year in which that last building first took credit. That's year 1, like Candy said. Add 14 years, and that's year 15, the date at which every single building within the project will be leaving its compliance period. And then maybe, I think that is the last question, but maybe we should keep going and more time for questions after Sean gets through the case study.
Well, thank you, everybody, for your questions. It's great to have some interaction here. Basically, I'm going to cover some case studies here that hopefully will address the issues that Candy and Laura have brought up. And these are actually real dispositions that either have occurred, and number two is actually occurring right now. But with that, let me jump into our first case study. Will be a nonprofit that has a right of first refusal in which there is actually equity in the real estate. The value of the real estate exceeds the value of the debt. Our second case study is also a nonprofit. It does have a right of first refusal, but this does have equity. I hope I said the first one did not have equity. The second one does have equity. And our third disposition is a for-profit that has a buyout option. They did not have a right of first refusal, just a buyout option to purchase the LP interest for value. So we can go to our next case, our first case. So this is the nonprofit, has a right of first refusal. It does not have equity in the real estate. We have 54 units located outside of Baltimore. The property serves seniors 62 and over, and that's kind of an important consideration. As you'll see, they have an age restriction there. The income skews from 30% up to 60%. The property was placed in service in 2002. The compliance period expired in 2016, so we just recently exited this partnership. But an important consideration for this deal and for all of our deals is this extended use period. Now, this particular property, the extended use period expired in 2041. You know, conceptually, these properties are at least 15 years old now, and this property has to maintain viable through the year 2041, and that comes up often in our year 15 dispositions. How are they going to fund capital needs going forward? That's an important part of our negotiations. Stakeholders in this are the general partner and limited partner. Of course, Enterprise is the syndicator in this partnership, as we are in all the case studies that we're going to talk about here today. We have a conventional loan for the in the first position, and then we have some agency debt in the second position. The allocating agency is Maryland, and a very important stakeholder, obviously, for us is our residents. Some of the negotiation points here, again, we do have a right of first refusal in this deal. If we were to exercise, or if the general partner were to exercise the right of first refusal, I will show you how the limited partner would receive $111,000. However, the general partner here made an offer to acquire the limited partner interest for $0. And the reason that they wanted to not have to pay anything for the limited partner interest are outlined here. There's a large surplus cash loan, a contingent loan that has been accruing over the years. The project cannot be recapitalized with a 9% allocation due to the age restrictions, and it's too small for a 4% execution. The property cannot be refinanced due to a prepayment penalty that's prohibitive, and the property does have long-term capital needs of $700,000 total. Now, we bifurcated this year to a $200,000 and a $500,000 for short-term versus long-term. And this is important when it comes down to value. If we're valuing a piece of real estate, all properties are going to have some level of capital needs over the next 15, 20, 30 years. But when it comes to value, we address, and this is common in the appraisal industry, they address short-term capital needs most heavily and or life safety issues. And the life safety issues are typically a short-term capital need. So this slide just presents a snapshot, if you will, of the economics of the property. When we value the limited partner interest, we start out with the value of the real estate. And when you apply an income approach to value, which is just you take the stabilized net operating income of the property, divide it by a cap rate, and the cap rate, or short for capitalization rate, is derived from the market. And we go out into the market through various resources to obtain a cap rate for that property in that location, that market. We divide that NOI by that cap rate and come up with the property value. We add to that any other assets, cash and reserves that are on the books. We subtract from that any kind of long-term debt, fees payable, or accruals, and we come up with a net partnership value. Now, as you can see in this slide, the net partnership value of this partnership is negative. Now, this is common for our portfolio. Probably roughly 80% of our portfolio does not have value at year 15 in excessive debt. And the reason for that is our portfolio is heavily focused on the lower income sectors. We're a mission-minded syndicator, and we want to make sure all sectors are, the needs of all sectors are met. So a lot of our properties are 30% of AMI and a skewing from 30 to 60%, but heavily focused on the lower income stream. So although this deal does not have value in excessive debt, the partnership does not have value in excessive debt. And arguably, if you look at a partnership that's upside down like that, you would assume that, hey, if the partnership's not worth anything, how can the limited partner interest be worth anything? However, as Laura mentioned, we still, before we even have our first conversations with the general partner at year 15, we do go through the partnership agreement. We recommend to the general partners that they do the same and look at their options for acquiring a limited partner interest. Now, this is a nonprofit that does have a right of first refusal. So for the purpose of this demonstration today, we're going to walk through what the right of first refusal would look like if they were to choose that option. Now, this is a right. They don't have to exercise the right, but they do have the right in their partnership agreement. So this is just a broad breakdown of how it would look. We have the value of the property is debt plus taxes, and that's per the partnership agreement or per the statute for them to acquire the property for debt plus taxes. If they were to acquire the property for debt plus taxes, that is the sale of a property, whether it's at market value or debt, which is the ROFR price is exactly that, it's a price. But if they were to acquire that property and sell the property, or buy the property, I should say, that triggers a dissolution of the partnership by definition, that would be outlined in your partnership agreement that type of event would trigger a dissolution. So associate that, if we're going to dissolve the partnership, there will be costs. So here we deduct $25,000 from the sale price, and we end up with net proceeds of minus $25,000. So this transaction, gives us net sale proceeds that are negative. We add to that the cash and reserves that are on the books, and then we subtract accruals and fees to come up with the total proceeds from a right of first refusal transaction in this scenario. The statute allows the property, not, as Laura mentioned this as well, the right of first refusal price is for the property, not for the reserves. So any reserves, net reserves or cash that are available may be distributed per the partnership agreement, may be distributable per the partnership agreement. So we're presenting this here for this presentation and this discussion today, but you ask yourself, why would a general partner exercise the right of first refusal when there's no value in a partnership? And actually the value of the debt exceeds the value of the property. Why would you pay more for something than what it's worth? This slide just shows a presentation of how the right of first refusal would play out as far as what the partners would receive upon the execution of the right of first refusal. Again, this would trigger a dissolution of the partnership. The partnership assets would be distributed. In most of our agreements, they're distributed per liquidation provision that is based on balances in the capital account. So in this scenario, we have capital accounts that are the total $223,000, but they're split evenly, roughly evenly, 50-50. This is very rare in our deals. Most of the times we see it's heavily skewed towards the limited partner by nature of how the investment was set up, but they have 99.99% of the equity in the property or the project. But here in this scenario, we have a 50-50 split. So anything that's available for distribution would be split 50-50. And if you do the math, you see the general partner would have a distribution of $111,000, the limited partner would have that same distribution. So this is just a snapshot of how the whole transaction would play out, or I should say, it's more of a bracket of how the transaction could have played out. You know, the top part of the slide, the financial summary, just reiterates what the economics of the partnership are. We have GP capital accounts that are roughly 50-50, so the distribution would go 50-50 of any distributable proceeds. But in that partnership agreement, and in your partnership agreement, you probably have a capital proceeds allocation that's defined. In this partnership agreement, that was defined as an 80-20 split. So if there was a capital event, proceeds would be split 80-20. But this is a liquidation event, therefore it's going to be driven by the liquidation, the language in the liquidation waterfall, and again, this was based on capital account balances, so it gets distributed 50-50. And the bottom just shows, presents a summary of how the values would have played out. And the highest one being $111,000 if they were to exercise the right of first refusal. The sale of a property and the buyout option is going to give you the same amount, which is really no proceeds available for distribution, so zero value. And how did we end up with this transaction? We negotiated a sale price of just debt. So the general partner was able to acquire the limited partner interest for just the debt that was already on the books. And from the fund's perspective, why does this make sense? Well, this proposal includes a long-term preservation after the fund exit. So we're leaving resources in the partnership to address capital needs going forward, et cetera. The investor benefits in this deal have been delivered, and we check this right up front, like Laura mentioned. As soon as we start looking at the year 15 deal, we make sure investor benefits have been delivered. We look at the fund IR. Most of our deals are, if not all of them, are exceeding target. This partnership agreement does provide the right of first refusal. However, it really isn't applicable because the value of the debt was $2.9 million. As you may recall, the value of the real estate was roughly $2.1 million. So it would not make economic sense for the general partner to exercise the right of first refusal. So again, we assigned our limited partner interest to the general partner for debt only, and the general partner will therefore assume all assets and liabilities. And this is our typical deal. Again, 80% of our deals do not have value in excess of debt. You know, strongly argue that if the partnership does not have value, then the limited partner interest is not going to have value. Now, our second case study here is actually a partnership that we're working on actively. The ink's still drying on these slides as we speak. This project is held by a nonprofit that does have a right of first refusal, and the property does have equity, significant equity in the real estate. This is a quick overview of the property, relatively large, 221 units. Again, rent are age restricted. Large rent skew from 30, 50, and 60%. Placed in service in 2003. The compliance period did just expire. And very importantly, again, we have a extended use restriction that takes us through 2048. So the general partner is going to be cognizant of the fact that, hey, I got to maintain this property for a long time. I want to make sure I have enough resources to keep the property viable. Some of the negotiation points that we're discussing to date, again, the property has significant equity in the real estate. They do have a right of first refusal to purchase the property for debt plus taxes. Now, one of our earlier questions about the release was about the restrictions on reserves. This disposition is heavily impacted by those restrictions, as you will see. The lender has restrictions that will not allow any project funds, including cash, their operating cash account and or the reserves, to be used to buy out a limited partner interest. The agency debt, or the soft debt, if you will, of $3.6 million is at 1%. The general partner, as you will see, will not be motivated to get out of that debt. That's very favorable financing terms. But that debt also has restrictions in place that will not allow, again, any cash or reserves to be used to buy out a partner before the year 2034 and or the repayment of that debt, whichever occurs later. So at a minimum, resources in the partnership could not be used to buy out the limited partner interest until the year 2034. There's also some additional regulatory agreements that are included, been imposed by the city. And we have a long-term preservation owner, and that's important. The story is important, but they do not have any economic or mission incentive to pay off that soft debt. And they're in the business of providing this affordable housing, and they want to stay in the partnership. So again, this is just a snapshot of the economics of the deal. Now, this is just a broad presentation here on purpose. I really want to focus in on the fact that of two important points, which are the large cash and reserve balances and the significant equity in the real estate. Here we apply the same methodology to value the partnership. Here we're applying a cap rate of 6% as a starting point. We do not have an appraisal on this property yet. If we divide the NOI by the cap rate, we come up with a property value in excess of $12 million. We add to that the large cash and reserve account at $1.3 million or $1.8 million. Subtract from that accruals on the debt, and we come up with net assets in the partnership of $5.2 million. So it's pretty significant. And again, my 2 points on the bottom there, we have 3.7 in equity in the real estate. However, this partnership does have that right of first refusal, but it still becomes a part of the conversation. And this is a calculation of how a right of first refusal would play out if the general partner were to exercise it per the partnership agreement. We have debt at $8.8 million, subtract those same costs for dissolution. We come up with proceeds from the sale of a negative $25,000. We add the cash and reserve, subtract other liabilities, and we come to potential proceeds of $1.4 million. Now, as I say down here, that this the same liquidation provision would apply, and in this case, the general partner essentially has a zero balance in their capital account, so the entire amount would go to the limited partner. So therefore, it would cost the partnership $1.4 million to exercise this option. Now, they do, arguably, they do have equity in the real estate, and they are going to have some cash on the books to pay for needs going forward, but that debt is restricted. And very important is the fact that those reserves and cash are restricted right now. As long as that second loan or second mortgage is in place and or before the year 2034, they cannot use partnership resources to pay for the buyout of limited partner interest. Back one. A little bit too fast, here we go. This slide just presents the impact of those restrictions. We have a public purpose lender that is mission-minded, and they're in the business of helping to provide affordable housing. Their associated regulatory agreement will not allow resources to be used to buy out the limited partner. The general partner does not have any economic incentive to refinance a loan even if they could, because it's at 1% financing. Why would you give up 1% financing? And again, in this conversation is very important to the fact that this property has to be maintained through the year 2048, which is a long time to address that, during which capital needs are going to have to be met. And the general partner is cognizant of that, and it's come up in the conversation, and it's a part of the story. So in sum, that can impact the value of what is really achievable in this year 15 exit. And the reality is there may not be anything that's distributable. We do have these lender restrictions in place which play a heavy role. So we haven't executed this disposition yet, and we're still in negotiation. We're having conversations. The general partner has recognized the fact that, hey, there's a lot of equity here. Somewhere down the road, they might be able to refinance, but that equity may be eroding. The expenses are going up over the longer our hold period is. NOI may be coming down. Maybe that equity is reduced. So we're still in negotiation here. It'll be interesting to see where we land with this one. But Ultimately, Enterprise's goal is to arrive at a fair and equitable amount that's fair for all parties involved. And our last case study is a for-profit that has a buyout option, and a good story. This is a relatively small project with 74 units. Again, we have this serves seniors 62 and over, heavily rent skewed at 30%, placed in service in 2002. Compliance period expired back in 2016. And here the use restrictions aren't as onerous, but the property still has to be maintained out through the year 2031. Our negotiating points here, as I mentioned, this was an interesting deal. The general partner does have a buyout option to purchase limited partner interest. They chose not to exercise the buyout option because it didn't make economic sense, as I will show you. Now, in this particular partnership, the general partner stepped into the deal back in 2012. At that time, the property was a very troubled asset, and actually, if I recall, there were some credits that were in danger. The investor in this deal, one of the investors in this deal, introduced Enterprise to this particular general partner as a good general partner, and suggested that we perhaps bring them into the partnership, which we did. As an inducement to bring that general partner in, the capital proceeds split, which is in our partnership document, it's Article 8, but I want to point out that that's different from the liquidation split that I mentioned earlier that typically drives any type of liquidation. Now it's typically driven by capital account balances, that liquidation waterfall. But in this scenario, they changed the capital proceeds split from 1090 to 90-10 in favor of the general partner. So to us, that says there was an idea here that to entice the general partner to come in this deal, they altered one of the splits. And that's important in the overall story. The general partner was able to turn around operations and turn it into a performing asset, and at the end of year 15, there was actually considerable value in excessive debt. Now, this general partner is a for-profit, and they have a very good reputation in the market for providing safe and great affordable housing. They made an offer, the general partner made an offer to the fund to acquire the limited partner interest for $300,000. They did so after consideration of buyout price and the liquidation value and fair market value, which was what an appraiser would value the limited partner interest at. And they also considered the purpose of the fund and why everybody got involved in this partnership in the first place, which is to help provide affordable housing. The final outcome of this negotiation, as you will see, was $500,000. Which made economic sense to everybody involved, and it was a good transaction. But I'm just going to break down some of the highlights of the transaction. So again, apply the same approach to value, capping the NOI at 6%, come up with a value of 3.3, add other assets to that real estate value, subtract all liabilities, and we come up with the net partnership assets of $2.6 million. Now, obviously, this is a significantly positive number. So we want to dial down to what the limited partner, what they're interested in that value is. So if they were to exercise the buyout price per the partnership agreement, follow the instructions in the waterfall per your limited partnership agreement, we have a value of the property of 3.3. Now from that, this is a proposal that they presented to us, and we confirmed it would have been the correct buyout option price. But here they deducted closing costs. So theoretically, if you were to take a property out to the market, expose it to the market, there'd be closing costs associated with that sale. From that, we subtracted debt, and we come up with sale proceeds of 2.1 for the real estate. We added the net cash and reserves and come up with total proceeds that would be distributable in the amount of $2.4 million. Now again, this is the sale of the real estate, so it's going to trigger the liquidation. It's not a capital waterfall event. This is a liquidation. It would be a liquidation event. And looking at the capital accounts, in this scenario, the general partner, and this is a typical split, The general partner had a very small capital account compared to the limited partner. The limited partner had over 99.99. The general partner had $100. So if they were to exercise the buyout option, it would cost them $2.4 million. So all the assets in a partnership, besides the real estate, would go to the limited partner, to the investor. Now, from the general partner's perspective, why would they do that? They already control the property. They don't have, there's no put option. They don't have to do anything here. It did not make economic sense for them to exercise the buyout option. So that was scenario number one. And scenario number two here, we're going to look at the fair market value of the limited partner interest as an appraiser would look at it. And this approach here is what they call the net asset approach to value. You also see discounted cash flow approaches to value, but this is a net asset approach, which we also use internally. And in this scenario, the capital account residual split is, or excuse me, not the capital account, the capital proceeds residual split is applicable by nature of the valuation methodology. And if anybody has further questions about this, you can contact me directly, so I don't get too bogged down in it today. But the capital proceeds split is important when determining the fair market value. If you were to take this interest out in the market, what's it worth? And here it was a 90-10 split, as we mentioned before. It was changed in the partnership agreement when the general partner came in. So we have net partnership assets of $2.6 million. The limited partner has a right to 10% of that per that residual split outlined in the LPA above. But this amount is would be discounted further by an appraiser. And there's two discounts that would be applicable, and that's a discount for lack of control and a discount for lack of marketability. If we apply those two discounts, we come up with a fair market value valuation of $150,000. So theoretically, if we were to take this interest out of the market to a third party, it'd be worth $150,000. And as I highlight here, the residual splits in this transaction drive the fair market valuation. Now, there's two discounts for lack of control and marketability. It's common in the marketplace. It's how the market perceives buying a fractional interest, which a limited partner interest is. And those amounts will vary, too. They could be as low as 30% total and as high as 99.99% total if there's a right of first refusal in the deal. And this, again, is just a snapshot of how we can bracket the value to see what a fair amount would be. Again, the top part just reiterates what the project financials are. And under the capital account balances, again, just showing that the general partner would really receive nothing if they were to follow if they were to sell the property in the market and or buy the limited partner interest per the buyout option, it would be very expensive, $2.4 million. And the final value, there is no right of first refusal here, so there's nothing to compare there. But the final value approach would be the fair market valuation, which gives us a value, the fair market value of the limited partner interest is $150,000. So if you recall, they made an offer in our first slide of $300,000, and we, through internal discussions and actual conversations with the investors, we agreed upon a price of $500,000, which seemed equitable and fair for all parties involved, given the history of the project, how the general partner turned the property around, and the economics of executing the buyout option and or the sale of the real estate. When the general partner already has control of the property, there is no put option, $500,000 made economic sense to everybody involved. And from the fund, to reiterate, we have benefits have been delivered, the IRR exceeded target. We did capture some residual value for the investor, which we are fiduciaries of our investors, so we want to maximize their return by, at the same time, meeting our mission and providing affordable housing and meeting the business purpose of all of the funds. And again, we assigned our LP interest, structured as a sale of a limited partner interest to the general partner for $500,000, and the general partner will assume all other assets and liabilities. some of the takeaways from today that hopefully you can recall will be that capital accounts can significantly skew how value is distributed. As in that last scenario, we had a capital account that was 99.99% to the limited partner, so therefore they would have gotten all the value if there was a liquidation event. The capital proceeds split, on the other hand, would drive a fair market valuation if there was a third-party valuation or a real estate appraisal followed up by an LP appraisal, limited partnership appraisal of the LP interest. One thing we did not really talk in length today about, but that you want to plan early to address any type of lender consents that are needed for an exit. And lender restrictions on cash and reserves may significantly impact value, like we talked about in case study number 2. It could erode any perceived value that's on the books. Extended use period is a hot topic at year 15, primarily because of the fact that we had to address, the partnership needs to address capital needs going forward and make sure that they're able to remain viable and provide affordable homes going forward. Most of our transfers are the sale of the LP interest to the general partner, which is just a simple transaction. And roughly 80% of our deals are like case study number 1, where there is no value at year 15 excessive debt. So it's just a simple transfer for no monetary consideration. Now I'm going to open up some more questions.
And just to reiterate, all participants will be getting an email within 48 hours with a link to the presentation. We had a few more questions on that. And it looks like we do have a few questions that were generated by the case studies. Where should we start?
So I see one question. It says, in case study number 2, what determines the amount the lender, they moved the question on me. What determines the amount that the lender would receive? There's actual documents, a regulatory agreement that was signed by the partnership in year 1 when they were able to get that loan that defines what's distributable. And in this particular case study, and actually we've had direct conversations with this lender for this case study or for this disposition. They clearly stated, not only did in the regulatory agreements, but they clearly stated that they will not allow a partnership resources to be used to buy a limited partner interest. Like most things, it's defined either in your partnership agreement or your loan documents or any kind of regulatory agreements.
And this question is related, I think it was related to the case study number 1, but a question about how reserves can be considered distributable, assuming they're inextricably attached to the building and or the state agency that restricts them, which must approve withdrawals. I think that was related to case study number 1, Sean, where maybe we had reserves that were distributable and or not locked down by the state agency. Sometimes we are also considering right of first refusals where the property is sold and the debt is paid off. And if there are restrictions, reserve restrictions by a lender, those restrictions may go away once that loan is paid off, in which case reserves could be distributable. And I say could because it always depends on the deal. It always depends on the specifics of the deal, the specifics of the restrictions related not only to the loan documents and any regulatory agreements associated with the loan, but also restrictions in place with extended use restrictions and so forth.
We would highly recommend referring back to your loan documents and your LPA, your partnership agreement, which should define how those reserves can be utilized at year 15.
Another question about, I think this question came in right as you were getting into case study number 2, but are there instances where the reserves are shielded from liquidation at disposition due to lender or agency restrictions? And yes, that's exactly what we saw in case study number 2. You saw that we came up with a net asset value of the partnership. Within this partnership, there is inherent value, and then, but dollar for dollar, that value was restricted by the lender. It was not distributable, so there was a reduction made to recognize that it could not be distributed. What if an LPA is old and really unclear? I assume it is just a negotiation with the GP and the LP on final terms. If the soft debt is way over fair market value and there isn't real cash flow, assume purchase of LP position would be zero. Certainly, that is certainly possible and common in terms of what we see. In terms of the LPA being old and unclear, however, some of that may depend upon a review by attorneys. Is the partnership agreement that determines if a GB has a right of first refusal? Yes, good question. No partner, no entity has a right of first refusal unless there is a legal agreement granting that right. That one. In year 16, can you reapply for LIHTC, or does the extended period prevent that? Good question. You can reapply for LIHTC, and you can do so before year 16. You can apply for new credits before your first initial 15-year compliance period even expires. There could be circumstances, however, just as a disclosure, where you have different and or overlapping affordability requirements, and you would want to make sure never to violate any of them.
And with that, it's time to conclude today's session. We've answered all the questions. We want to thank our panelists, Andy, Laura, and Sean today for your information and insight. And thanks to everyone joining us today. We hope to see you online again soon at another Enterprise Live online event. So bye and have a great day. And I'm going to post really quick our contact information for you. If you have any questions, please feel free to reach out to Laura, Sean, or Candy.
Yes.
Have a great day.
Thank you, everybody.